thrust on infrastructure spending, revival in corporate investment, healthy bank credit, and moderating commodity prices will also go a long way in terms of supporting the Indian economy. Despite the increase in interest rate and its transmission, credit growth has continued to grow in double digit and has been broad-based across sectors in the financial year 23. During financial year 23, all scheduled commercial banks credit grew by 15% YOY, as against 9.6% YOY in financial year 22, while aggregate deposit of all scheduled commercial bank grew by 9.6% YOY compared to last year's growth of 8.9% YOY. In the Union Budget for financial year 24, several steps have been taken to push up the capital investment in the country, which will eventually boost the credit demand in the country. We expect credit growth to continue in financial year 24 also, although some moderation might happen here and there. In the above economic backdrop, let me now give some color on the bank's number for financial year 23 as well as for the quarter 4 of financial year 23. I'm pleased to announce that for the third quarter in running, we have posted our highest ever quarterly profit of 16,695 crores. For the full year, our net profit has crossed the landmark number of rupees 50,000 crore, which is the highest ever by any bank in India. Net profit for financial year 23 increased by 58.58% on a YOY basis to 50,232 crores, while operating profit at 83,713 crores increased by 11.18%. ROA of the bank for the year improved by 29 basis points on YOY basis to 0.96%, and ROE improved by 551 basis points to 19.43%. For the quarter 4 of the financial year 23, net profit stands at 16,695 crores, which is higher by 17.52% sequentially and 83.18% on a YOY basis. Most other core profitability metrics have also improved over previous year as well as sequentially. Net interest income for the year increased by 19.99% YOY on the back of improvement in yields and continued credit offtake. Domestic NIM also improved by 22 basis points YOY. Non-interest income declined by 9.73% YOY, mainly due to the MTM losses which we had booked in the first quarter. It was to the tune of about 7,000 crore. Other than that, our core income streams, that is fee-based income, have remained intact and have improved by 6.84% YOY basis. Operating expenses increased by 13.68% YOY as we have started building provision for the wage revision, which has fallen due from November 2022. There is some increase in overhead expenses, mainly coming through higher tech-related expenses like expenses on IT development, mobile banking, ATM, etc. And also the higher DICGC premium because of the growth in deposit. On the business front, credit growth has been robust across all the segments. Domestic advances grew by 15.38% YOY, headlined by retail personal advances, which grew by 17.64% YOY, and corporate segment witnessed a growth of 12.52% YOY. SME and agri segment have also witnessed a healthy double-digit growth at 17.59% and 13.31% YOY.
Some guidance there as well.
I think one question itself is quite a heavy questions, multiple questions in one question. So you have taken the full advantage of the clause one question. Anyhow, I'll start with the first one, which you have in your mind is something which is very heavy on your mind, is relating to expected credit loss. Well, of course, first and foremost, this is just a concept paper which has been introduced by RBI, and they have not yet formed up their views. And even if They have very clearly indicated in that concept paper also, even if it gets introduced, it will be spread over a period of 5 years. Now, let me share with you. When it comes to the ECL, it essentially means that the provision would be made based upon the expected credit loss. And expected credit loss is a probability of, one is a loss given default, LGD, and also the probability of default. So which is nothing but a reflection of the underwriting standards, and also at the same time, how the book has been. Herein, I would like to draw your attention to the fact that our corporate book is provided to the extent of 98%. And when it comes to our retail component, which is almost as high as about 42, pure play retail is about 42%. There our NPA, gross NPA ratio is somewhere in the range of 0.6. So one, I would like to say that the loss given default as it is low. And even the probability of default, which is nothing but a reflection of the underwriting, what we have seen for last couple of years is a very clear reflection of our underwriting standards which we are adhering to. So in that kind of a situation, I would like to mention that our non-NPA provisions as on date stands at about 35,500 crore plus. So as far as our readiness is concerned, we will simply wait for the RBI guidance in this matter. And once the guidance comes in, we are very well equipped to deal with the scenario. And at some stage, we have done some calculation, but those numbers are much lower as compared to what additional provisions we are already holding in our balance sheet. So first and foremost, ECL as of now is a fiction. And if at all it becomes a reality, we are very well equipped to deal with without having any impact on our balance sheet. We have always followed the principle to insulate the balance sheet fully, and our balance sheet is completely insulated from any future potential events also. Now, your second question, which I can recall, was essentially relating to the growth numbers, whether it is credit growth guidance. And also, your one question was relating to whether the kind of slippages which we are seeing, how will it look like going forward? I think, to my mind, the best of the answer for this question would be to look at our SMA-1 and SMA-2 book, because this is nothing but a reflection of the likely stress which could be there in the book. So if you look at our SMA-1 and SMA-2 book, we have seen very clearly that there is a definite reduction in the SMA-1 and SMA-2 book over the period of time as compared to March 22, where it was 3,544 crores, SMA-1 and SMA-2. It peaked out somewhere around 8,000 odd crore in September 22, but again it has come down to 3,200 odd crores. We are in a position to have a very effective follow-up mechanism, and we are in a position to ensure that we recover all these stress accounts. So I think, to my mind, the quality should be what we are seeing today. We should be in a position to sustain. The third question was essentially relating to the growth. I think we are witnessing decent growth both in corporate and retail, and also even in SME as well as in agri. So I think, to my mind, the kind of activity which we see on the ground, which very clearly means that we should be in a position to address the economy's growth requirement. And I would like to also add that the macro aspect is something which will be a very, very critical component, and the kind of focus which is there in the economy for the economic activity, this will certainly offer us opportunity to grow as far as our loan book is concerned.